Welcome back, everyone, to Real Estate Revelations, the series where we make numbers fun. I'm your host, Builder Broker Britt, and today we're diving into the magical world of calculating the effective gross income, or EGI, of a rental property. Now, don't let the fancy names scare you off. It's easier than you think. Grab your calculators and let's get started. First things first, let's talk about what EGI is and why it's important. Effective gross income is the total income a property generates from all sources after accounting for vacancy and credit losses. In simpler terms, it's the money you're actually pocketing before you start paying off expenses like repairs, management fees, and utilities. Think of it as the bridge between potential and reality. Now, how do we calculate it? It's a three-step process, the first step being a calculation we just learned. Step 1, calculate potential gross income, PGI. Step 2, account for vacancy and credit losses. Step 3, add miscellaneous income. Now, let's break it down. Step 1, calculate potential gross income, PGI. If you watched the last video, you'll know that this is a pretty straightforward calculation. As a refresher, PGI is essentially the maximum rent you could collect if your property was fully occupied all year round. For example, if you have a rental property with 10 units, and each unit rents for $1,000 per month, your annual PGI, 10 times 1,000 times 12 equals $120,000. The annual PGI would be $120,000 piece of cake, right? Moving on, step 2, account for vacancy and credit losses. Here's where reality sets in. Not all units will be occupied all the time, and not all tenants will pay their rent on time. This is where we subtract a percentage to account for these losses. Let's say we expect a 5% vacancy rate and a 2% credit loss rate. Combined, that's a 7% reduction. Now, before we actually calculate the loss, let's define a vacancy rate and a credit loss rate. I like to call the vacancy rate real estate's version of a ghost story. The vacancy rate is the percentage of all the rental units in a property that are unoccupied at a given time. Imagine your rental property is a party, and the vacancy rate is the number of people who RSVP'd no. It's that haunting little number that reminds you not every unit will be filled with a happy tenant all the time. So, while you're dreaming of full occupancy, the vacancy rate is there to keep you grounded. Like a spooky reminder that not every chair at the table will always be taken. The credit loss rate is something like the pothole on the smooth highway of rental income. This is the percentage of rent you expect to lose because some tenants can't keep up with their payments. Imagine your rental income as a road trip. The credit loss rate is that unexpected pothole that gives you a little jolt, reminding you that not all tenants will be as punctual as your morning alarm clock. So, while you're cruising along, enjoying the steady flow of rental income, keep in mind those occasional bumps in the road, the credit loss rate that can slightly detour your financial journey. Now let's calculate the vacancy and credit loss rates for our example from earlier. Loss equals PGI times loss rate. Using our PGI of $120,000, loss equals $120,000 times 0.07 equals $8,400. Subtract that loss from the PGI. Adjusted PGI equals PGI minus loss. So for our example, the adjusted PGI is $120,000 minus $8,400 equals $111,600. The adjusted PGI in this example is $111,600. Are you still with me? Just hang tight. I promise we're getting closer. The final step is adding miscellaneous income to reach our final number of the effective gross income. Finally, we add any other income the property might generate. This could be from laundry machines, parking fees, vending machines, valet trash, or any other sources. Let's say you make an additional $3,000 a year from these sources. EGI equals adjusted PGI plus miscellaneous income. For this example, EGI equals $111,600 plus $3,000 equals $114,600. And there you have it, folks. The effective gross income for your rental property is $114,600. Remember, this number is crucial for evaluating the property's performance and making informed investment decisions. So next time you're looking at a rental property, don't just stop at the potential gross income. Dive a little deeper and calculate the EGI. It's like peeling an onion, except it's way more rewarding and doesn't make you cry. Thanks for tuning in to our second episode of Real Estate Revelations. I'm Builder Broker Britt, and remember, numbers don't lie, but they do need a little massaging. Until next time, happy investing. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more real estate tips.